companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities, or it's now the Bond Show. My name is Todd. I'm from FIIG Securities. And if you have any questions, please give us a call. If you'd like to talk about the share market or the bond market, pick up the phone 1300 30 34 35, or you can email us. And the email is yourmoney@skynews.com.au. Now, joining me tonight on the panel is John Noonan from Thomson Reuters, and we have Mark Bailey from Equasia. Mark's come back after a long trip in the United States. We'll be talking to him about the States. But we'll start with you, John. Thomson Reuters, massive business. Tell us a little bit about who would be using your services in terms of that information.
Right. Well, I work in a group called the IFR Markets, and we're all, we're not journalists to begin with, we're all ex-market people. There's four of us, about 90 years experience between us, focusing on the foreign exchange market. We have ex-RBA and ex-bankers working for us, and most of our clients are the professional, or subscribers are the professional base, banks, investment banks, funds, and central banks.
You know, when you mention 90 years, we are just really old, aren't we? We hope the viewers out there really appreciate how old we truly are. You can't say that you've seen it all, but you do see a lot of it. We've got problems. We've got the Australian cricket team. You know, that's a disaster. We've got the government sort of playing around, and that's all, you know, it's a bit of a comedy. But volatility in both those asset classes, cricket and politics, we now have it in equities, where Mark, I suppose, 2 or 3 months ago we weren't expecting it. We had the fiscal cliff. It was all sold. It was all fine. Equities would rally hard, and we have a problem. So how do you think this volatility plays out over time with the investors?
Look, I mean, the cycle's always the same. You know, whether it's good times or bad, it's always risk and greed, and the investor sentiment always overcorrects one way or the other. And the start of the year, as it was the case last year, you had investors that were overconfident. You know, greed was ruling the roost, and you know, everyone was happy, everyone was making good money. But Europe is always on the table, and you know, Cyprus has come back and bidden Europe in the bottom, and it's got that problem to solve. But the big concern for 2013, as I said before, it's going to be Europe, and volatility has come back, whether you look at equities or you're looking at bonds as well. And I think it's important that investors should look at volatility and not just look at purely the returns. They should look at the volatility of those returns. Returns should be looked at a risk-adjusted basis, and that's why you have a balanced portfolio. That's why you have some bonds that are lower yielding but lower volatility in any portfolio, you know, to offset those equities that are higher risk and higher return.
But for the viewers at home, if you talk about a risk-adjusted basis for volatility, give me an example of what you would mean by that, because it sounds great. I get it. I understand what you mean. But if you were talking to the people at home, what would you mean? How would you assess that volatility piece?
Well, I guess it's, you know, it's the same as, you know, having some money that you can sleep on at night, and you know that, you know, time and time again it's going to give you, say, 4%, 5% return, and there's going to be no volatility there. That's going to be the return year after year after year. You know, government bonds, for example, you know, would do that, whereas you've got maybe equities that maybe return 7, 8, 10% one year, you know, maybe 15% the next year, maybe -5 the year after. So you've got the volatility there, but you've got a higher return. So on average, yes, maybe you get 7, 10% return in to equities, but it's a higher volatility there in terms of your returns that you're getting.
So John, over to you. That idea of traditionally the equity market rallies, the bond market must get sold off. We have to have that sell off. We have to have that interconnected. What do you think of that theme?
It's overblown, and you hear a lot of people say that you know they're going to see this mad rush out of bonds into equities. Get out of bonds right now. There's a bubble there. It's going to burst, and equities is the safe haven. Almost equities becoming a safe haven in that case. Now that was true in the 70s, 80s, and into the 90s when you had these massive spikes in inflation, in these boom bust cycles that we had. You know, it was the typical. You know, the economy would be going well, equities would go up, central banks would start raising interest rates, bonds would get absolutely slaughtered, and then the central banks would raise rates too much, and bing, back in recession, equities slaughtered and bonds go up. It's a different world right now. We're seeing huge accommodation by all the developed central banks, And we're not seeing those inflation. In fact, most of the developed world, with the UK being the exception, they're more worried about deflationary pressures still. Yeah. And that's due to household deleveraging, more productivity in the workforce because of technology, etc. So it's a perfect time to have a balanced portfolio because you're not going to get killed on your bond market, even if we do have an equity market rally. I'm fairly bullish on equities going out to the end of the year, but I think a balanced portfolio is never a better time to have one.
Yeah, and it's hard for when you hear people talk about the bond bubble. I mean, I think we spoke about it last week with John Pearce from UniSuper about the idea that we are so equity focused, and he said we need to start looking at different asset classes and how they should perform. So he had REITs, and he was saying, okay, if somebody wants a REIT, which they at UniSuper had at a 5% return, that was reasonable for a portion of your portfolio. But I think it's very hard to get people to come to grips with that, isn't it?
Yeah.
It's not like the paper is saying this is what balance looks like.
Yeah, and I think it's important not to look just purely at the volatility, it's also the correlation between those two asset classes, bonds and equities. They do balance out, and they've historically done that. Maybe not so much going forward, but they won't certainly return in tandem the same returns. There'll be a bit of balancing impact, and that's important for any portfolio, that if you want the stability of returns going through, and it should be something that investors look for in terms of getting a diversified portfolio, not just purely equities versus bonds, but also within those asset classes, whether it's banks, resources, retail,
financials versus
exactly,
Coles or Woolies or something.
Exactly. Yeah.
Cyprus raised its head through the course of the week, and let's get your thoughts on it, John. Is it a game changer? Is Cyprus something that everyone at home should say, oh my gosh, it's Cyprus? How should they react to it?
Well, there's two schools of thought. One is that here we go again, and this could be the last straw for the eurozone. We could see Cyprus leave the eurozone, leave the euro, which would be a dangerous precedent. Then you have those saying, well, it's so tiny, it's the size of Parramatta, and who cares? And even if they do leave, I think it's somewhere in the middle. One good thing that we've seen so far is we haven't seen contagion. I was worried at the beginning of the week we might see some runs on banks in Portugal and other peripheral countries simply because they raided the deposit base, or they meant to go out and do that, and the EU approved of that. That is a very dangerous precedent, and I think that could come back to haunt. Even if we don't get any runs on banks now in the periphery, what if the Portuguese economy starts going backwards, which it still is, but what if it starts really going backwards? They have a very fragile banking system, and there's something in the air that maybe a Portuguese bank might need help. The depositors of that bank are going to head for the hills, and why wouldn't they?
Yeah, what do you think?
Yeah, no, I generally agree with John. I mean, I think that on the face of it, Cyprus shouldn't really matter. It's just such a small blot on the landscape, but the way that the EU has tackled the crisis in Cyprus has been crazy. It's set precedents. It's attacking deposit holders. Now they're talking about maybe setting up a good bank, bad bank, where any deposit over 100,000 goes into the bad bank, and maybe as a depositor you're going to talk about getting 60 cents back in every euro. I mean, so you're going to take a haircut of 40% on your deposits, and if that happens, and that's kind of a blueprint, and the genie is out of the bottle now, so if any kind of restructuring happens in any other country, investors potentially will think that would happen.
That's right.
And so maybe you're working your way down the capital structure, so senior bondholders are in the hot seat as well, subordinated and equity holders. So again, investors are kind of left uncertain as how to proceed and how to judge.
Let's talk about that capital structure in a second. But the other thing that was interesting was in the Cyprus attitude, it was, well, it's just the Russians. The Russian deposit holders were such an extensive part of that banking arrangements. Now, I have two questions. What did you think you're trying to achieve by saying it's just the Russians and therefore we'll punish them? But also, what return were those Russian lenders getting on their deposits? I don't know what, euros at zero, so I couldn't imagine it was that amount of money. It doesn't really make a lot of sense to me why you then say, let's take on that Eastern Bear, and then we're trying to punish people because they put money with the Lucky Bank. I mean, that doesn't really make a lot of sense.
Yeah, I mean, from what I've read, I don't think Russia has a huge deposit base within Cyprus. I think it's around about 30% of all holdings. So it's a significant piece, but it's not by all means all of it. But the fact that they were targeting sub 100,000 deposits means the pensioners, the man on the street is getting hit by that tax, which was meant to be 6.75%. It will go back to be potentially changed, and maybe that 100,000 guarantee will be in place. Depositors' guarantee that they promised within the EU will hold. But I guess the easy target was Russia, and maybe the idea was to try and bring Russia to the table for a bit of financial assistance. Obviously, the finance minister of Cyprus has gone over there to maybe offer some gas
That'd
assets
be an interesting conversation,
or a naval
wouldn't it?
basis.
Absolutely.
Yeah, but at the moment, there's been no deals on the table, and they've probably had to go back to the EU, and that's why they've kind of had to go down the bad bank, good bank.
And what's your interpretation of that Russian piece?
Well, it's a bit ironic. I think one of the reasons, there's a bit of history there, and one of the reasons Germany decided that it was okay to go after the big deposit holders, and it was actually Cyprus who said no, we're going to have to go to the small ones too, because they didn't want to really annoy the Russians too much. But one of the reasons was that a bit of history, what could have happened, and I don't think it will, Russia could have bought into this, establish a naval base off of Cyprus, have access to the oil fields, the gas fields, in which case Russia controls most of the gas going into Europe anyway. They'd even get more control. So it could have really come back to bite them. So again, it's the Eurozone, very bad planning, not really thinking things through to the end, and it's just structurally unsound, as you said before. Their planning just isn't there.
I mean, Bill Gross out of PIMCO, who runs PIMCO, said, Europe hands off, leave it alone, buy US Treasuries, dollar euro gets belted. This is crazy. This is just very poor performance. But one of the things that he often talks about in PIMCO is that the regulators seem to always look to punish, at this point in time, the savers. Everyone that saves money seems to be, whether we see it here with our pensions, where people have saved, self-managed super funds have put a lot of money in it, and a parliamentarian goes, oh, that's a lot of money there, I wouldn't mind having a crack at that. Why do you think, I mean, Gross is right, so how do you think the savers should react? How can they react?
Well, in Cyprus they can't, because there's going to be a capital freeze on what they're allowed to take out of the banks when and if they do open again next week. They're not going to be allowed to cash checks, and there's going to be restrictions on capital flows out of the country. There's also talk that maybe that pension fund within Cyprus is involved in the whole bailout as well, kind of pretty similar to Ireland, where the Irish pension fund was involved in helping the banks out as well. So I think obviously Australia is different, and I can't envisage that happening here. But equally, the environment for business in Australia has been pretty challenging. There's been all kinds of taxes that have raised and popped their head up, that have had to really focus businesses on the political risk within Australia that potentially 2 or 3 years ago you wouldn't have thought was there.
When they talk about the RBA governors come out and talk about productivity, and they talk about the Australian economy and its productivity, I see that as code for saying that you're going to have to work longer and harder for less money. How do you interpret the idea that we are a more productive society?
Yes, well, Philip Lowe spoke about that in his speech last week, in almost defending, or not defending, but acting quite sanguine about the high Australian dollar, saying, well, it actually helped us when we had some inflation worries earlier, and now we've found that it's increased productivity. And what you're saying is exactly right. What that means is that companies who are getting absolutely fractured by the high Aussie dollar have had to lay off. They've had to go very lean. They've had to adjust to the fact that the Australian dollar is extremely high and makes them less competitive. So yes, that could be called productivity. Probably shows up in the numbers, but the toll for that is quite great.
Don't you think that the job market itself seems very fragile? We had that great print while you were on holiday in the United States. 75,000 employment, far above what everyone expected, and everyone looked around and said, who's got the job? I just don't get it. And it's interesting how the job market feels fragile, but we see these numbers printing higher. Yeah, no, it was pretty strange in terms of the numbers that came out. I saw a couple of reports that maybe it's the way the statistics are collected, that maybe it's some of the people that were rolling in and rolling off out of the survey, there was some kind of statistical anomalies there, and that was dependent on the high print. But I think also as well, you've got to look, there is a bit of softness in terms of the split between part-time and full-time jobs. Full-time jobs are still up only slightly, whereas a lot of people are more part-time. So I think there's a lot of underemployment there, where people would like to work more hours if possible, but the job market isn't there. But I'm with you. I mean, I see that every day, that people would like to work more, but the jobs aren't there. So I'm surprised. I was surprised at how strong the numbers were. I
think there was a bit of an overreaction to the numbers. I think it could be a statistical anomaly. We'll have to see 2 or 3 months before we go any further. And one of the dangers of overreacting to the numbers is that if you look further down the road, and if you read what the RBA is saying, with the peak in mining investment, employment is a worry going forward, going towards the end of the year.
Clearly it's a worry. The RBA in their statements have said there will be another sector that will take over. And
hopefully.
Whom would that sector like to be? Who wants to put themselves at the front? It's like Kevin Rudd. He doesn't want to lead. Which sector wants to lead? Because it seems that they would like to think it's the construction sector. They move the cash rates down low enough to stimulate that boom because of, I mean, John, you and I are talking about it, the diversity of that employment mix is quite strong in the construction sector. That makes a lot of sense. But the end user is so conservative. You know, the person, everyone is delevering because their job is very nervous. So I think it's quite challenging.
Yeah, I agree.
And they're not going to get any help from the governments. There's not going to be any government spending on new construction, so it's going to have to come from the private sector.
Now we're going to have to leave it there. We go to a break, but before we do that, we're going to crank up the speed round, and we've got Mark Bailey. He's going to have 30 seconds, and he's going to talk about his bond of the week.
My bond of the week is MYOB, which is currently trading around about 93 cents in the dollar, which yields in about 12.25%. Came out with results which were pretty much in line with expectations, a bit of growth from EBITDA and revenue, and in line with expectations. I think at the current levels, given risk profile for investors, I think it's a pretty good time to get involved in that name, and it has traded down recently in the past month on no real news. And that's my bond of the month.
Great. We'll bring that down up. Welcome back to Your Money, Your Call. Tonight I'm joined by John Noonan from Thomson Reuters and Mark Bailey from Equasia. They're here to answer any of your questions on bonds or the equity market. Please give us a call on 1300 30 34 35, or you can email us, and the email is yourmoney@skynews.com.au. Now, just before we enter the break, Mark, we spoke about MYOB. MYOB?
MYOB, yeah.
It's an unusual name, isn't it? You know, you could have a real crack at that. I think Jade would like to bring up the chart and show MYOB, which looks to be, that seems to have been challenged by some aspects there, but that's your bond of the week. And do you want to walk me through that one again? Because it's kind of fallen off the cliff a little bit.
It has,
which is clearly great buying opportunities in your mind, but can you explain to me why?
Absolutely. Well, I'd love to explain why the price has fallen off the cliff. I mean, the big steep drop is a coupon. So what you've got to remember with hybrids trading on the ASX is that the price there is always gross price, so it's always with coupon. So that was a coupon payment. But the back end of February, 28th of February, they came out with financial year end 12 results, which were pretty much in line with expectations. You know, they had revenue growth of around about 2.5%, EBITDA growth of 0.7%. You know, from the last 12 months in September, so not spectacular figures, but you know, from a bond investor's point of view, steady as she goes. They had a conference call this week, which you know I thought went well. Management came across well, and they helped to highlight a few issues that investors were struggling to understand in the previous results. There's been a lot of press about some of the stock kind of competitors maybe taking market share, Intuit and Xero, but on the call they reiterated that their business still seems to perform to plan. They've actually increased recurring revenues during the course of last year from 85 to 88%, which indicates to me that you know it's a fairly stable business. It's almost like an annuity business, and customers are pretty confident with and comfortable with the product.
If I bought that today, what sort of return am I expecting to get on that number if it goes back to par?
If you hold it to maturity, which is December 2017, you'll be getting around about 12.25%.
Right. And the fear of the people who are selling these assets are saying that there'll be another MYOB around MYOB version 2 from somebody else who would take their market share. In taking their market share, what happens to the bond? Are they saying that they won't be able to pay their debts, or
well, I mean that's what the price action is telling you. But I'm saying that from a fundamental point of view, from a credit analytic point of view, there's nothing changed. The company has performed in line with expectations, and this is a pure technical sell-off. I don't know whether people are getting spooked because they're seeing it fall in price, and there's no real reason out there.
The volume isn't overly extensive. If you look at the numbers down the bottom, the bar charts for the viewers at home, the bar charts down the bottom show the volume. It's not as if it's massive volume either. It's
no, I mean that's the thing. It's a fairly liquid stock. I guess it's kind of comparable to a small cap stock on the ASX. You know, there's not a lot of volume, daily volume in there. So I guess if there's a couple of large sellers that come out of the woodwork, it will drive the price down. But that, you know, equally it presents itself as an opportunity for those people that look at fundamentals such as ourselves and our fund. which we do hold in our fund and still continue to like the name. And just because the price comes down, the fundamentals are the same. It offers a better buying opportunity.
If I'm looking to construct a portfolio and I don't have that in my portfolio, I don't think I'm going to put all my money on this thing. But I'm certainly saying at 12% fixed income assets, that seems to be worthwhile 20 cents in the dollar. It seems to have some sort of benefit. How do you compare this with HealthScope? Because we've had some people ring in the last few weeks about HealthScope. That bond, they issue it, they announce it in the day and they close it in the afternoon. It was the quickest thing. People have lost fingers on that thing and they bought it so quickly. So it's clearly a dangerous bond and it's into the health industries. What did you think of that compared to MYOB and the like?
Yeah, I mean, it's on a comparable basis in terms of the leverage. All these bonds, both the bonds are high yield bonds and they're not rated, but if they were rated, they'd probably be rated somewhere in the single B type territory. So it's heavily sub-investment grade, junk bond, high yield, call it what you like, which is why the returns are so high. When MYOB was issued, it was issued at 10%. The new HealthScope bond was due to price in terms of size at 150 million, and the yield on that was anywhere between 10 and a quarter, 10 and 3/4. They upsized that to 300 million, and the price out at the tight end at 10 and a quarter. It hasn't started trading on the ASX. However, HealthScope does have another bond out there, which is about 2 years earlier, shorter in maturity, and at current levels, that's kind of giving you roughly the same yield at 10 and a quarter. So we do like both HealthScope bonds, but at current levels we prefer the shorter dated one, the one that's existed because of the same yield.
John, you've been in banking and trading for, as you said, 90 years.
Just feels like that.
That's just a normal curve, though. You'd buy that because of the curve. In other words, if something's 2 years shorter, you'd always go for that one. Same credit.
Absolutely, and obviously there's less risk and you're getting the same yield for less risk because of duration.
Yeah, so for the viewers at home, I mean, that's just understanding that curve. It's just a matter of... And that's a hard thing to get your mind around when you're investing. A lot of people say, I'm investing for an awfully long time. The Sydney Airport 30s, the inflation link is at 4.5 over or whatever. It's roughly around 4.5 over plus CPI. I can't tell you how many people will say, that's a long time. And my response is, how long will you be with us? Because you need to have something that will protect a portion of your portfolio. So if you're constructing solely bonds, which you shouldn't do, but if you were, 10.5, 12, something with an inflation kicker at 4.5 like a Sydney Airports, you start to get a very nice performing portfolio that will give you around about 8 if everything's fine. Buy some senior debt at 5 3/4. Preco's now trading at I think about 5.8. A nice infrastructure bond. These are good things to then say, now half my portfolio might be in all the banks and whatever you might want to deal with. You'll have some things that look for some edge.
That's right. Have variety.
Yeah, exactly.
Absolutely. The spice of life. Now it's time to take one of your emails. We have an email from John. He's from Melbourne and he writes, I'm hearing less talk about the bond bubble. Does that mean the concerns have ended? Can I go to you, John? What do you think about... There seems to be slightly less talk about the bond bubble, but you're at the forefront of it. Are you hearing that?
Well, I think some people feel that if there's a bull market that goes for as long as the bond market has gone for, it has to be a bubble. To me, it only becomes a bubble if inflation, if they're still buying bonds and inflation's on the rise, then yes, it's a bubble. It's mispriced. And I don't think that's the case right now. And I believe that in most of the developed markets, bond markets, particularly, the low risk ones, there isn't a bubble. I think there was a little bit of a bubble we saw during the height of the panic, when the 10-year Treasury yields went down below 1.4%, and there was negative interest rates being applied in some of the short date bonds in Europe, etc. That was a bit overdone. That was ridiculous. But I think where things are right now, it's not a bubble, unless, of course, the inflation pressures start to build.
Yeah, I mean, I guess I think investors have to be cautious that, where yields are at the moment, there's probably very little downside potentially in yields, upside in capital price. The central banks are keeping rates low, and they will do for an extended period of time, probably mid-2015 is the current Fed indication, and that's probably still the case. So yields could stay where they are for another year and a half, 2 years, and then probably slowly start to track up. But are you going to see a huge loss of capital No.
Which is a bubble. When a bubble bursts,
exactly.
Yeah, you lose your money.
Yeah.
But that, that's not necessarily the bond market, especially not the government bond market. The US Treasuries, you should always get 100 cents back on the dollar if you hold that to maturity. Yes, there will be capital volatility in the meantime in terms of how interest rates move, and that will impact you further down the curve. So if you're holding a 30-year Treasury and rates do move, yes, you will see a fairly significant decrease in your capital price. But if you hold that bond to maturity, you'll still get 100 cents in the dollar.
But do you think that in terms of the bond bubble that everyone talks about, I always feel they're talking about the sovereign, the government bond curve. So when I hear the commentators ask me a question, they're not talking about Healthscope.
No.
We did a bond, Mackay Sugar, this week. It was a $50 million bond, 7.25% for 5 years. It sold in a day. It was sold in an hour. It just went out, And I felt, that's interesting. That's not necessarily saying to me there's a bond bubble. There's just people are really conservative, and if the Australian curve, Australian 10 years at 3%, cash at 3%, I don't think everyone at home should be buying that. But I don't feel that there's a bubble in terms of the corporates. I don't feel that. I mean,
no, and that's part of the way you protect yourself. You either, if you think there's a bond bubble, then you go shorter duration. And then also you go down the
So for the folks at home, when you say shorter duration, Mark is talking about by 1 year paper, 2 year paper. You're not saying by 30-year.
That's right, shorter duration, yeah, 1 2 year in terms of maturity, rather than longer dated. Obviously you can't buy 30-year in Australia, but in the US Treasury markets. And also another way to protect yourself from higher rates is to have a higher coupon, and to do that you need to have a lower rated credit, so either a investment grade, so above BBB- and above, or if you want to have a risk profile, you go into high yield, and that's a bigger coupon, and again that protects you in terms of shortens your duration in terms of your cash flows that are due to you on the bond, makes it shorter with a higher coupon, and again that protects you from inflation.
And John, you can buy floating rate notes, can't you? You can buy things that will go up with that interest rate. So the bond bubble becomes slightly different, because I feel the part of the bond bubble was all talking about the absolute cash rate.
Yes.
Is that how you read it?
Well, no, I think it was in the States. They were basically talking about what was going on with the 10-year bond. The 10-year bond, which was trending, the yield was trending low, the price was trending high. At some point, it was going to become completely mispriced, and it was going to explode. And suddenly we'd be seeing 10-year rates at 4%, and everybody who thought they were playing safe by investing at 1.7, 1.9%, we're going to get absolutely slaughtered. But I don't see that happening. And the only way, as I said, that could happen is if there's a massive circumstantial change and you suddenly see inflation fly out at the other end of what the Fed is doing.
Let's just stick with that inflation thing, because when we had Stephen Nash on the other week, he goes to a lot of the portfolio construction seminars and conferences, and he would say on day 2 of all those seminars, the whole day is inflation. Everyone is conscious of it. Everyone is worried about it. It's the ticking time bomb that no one knows how to trade, if you like, or protect against. It's not a question of will it happen, it's when will it happen. How do you read it? What are your thoughts on the inflation piece?
Well, when you see it, it's time to head for the hills. But there is no sign of it right now. And I think what's happening is that we're still going through the deleveraging process of the households. Companies are doing it. I don't think we're done with that yet. We might at some stage be, but I don't see that happening yet. So when you see, there's the signs of inflation, everybody's nervous about it, of course, because what the central banks are doing is so unorthodox. We've never gone down some of the roads that the Fed and the Bank of Japan are going down right now. But let's see what comes out the other end of it, and until you see it, you can't run away from it.
Well, John, you've obviously got a lot of views here, so we're going to get those views. We're going to start the speed round with you, and as you know, we need to know in the next 12 months where you see the cash rate, the equity markets, the credit markets. Your time starts now.
I think the cash rate is going to go down to 2.5%. I'm still in the bullish camp on that, the dovish camp on that. As far as the ASX, I think it's probably going to go down for a little bit now, but I think by the end of the year we'll be closer to 5,400. And what was the other one? The Australian dollar. Okay, the Australian dollar, I see very conservative on that one. I see 104.5.
104.5. Okay, well, thank you for your 30 seconds. You've gone early, but we'll still carry it on for another.
Oh, sorry.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities. I've got John Noonan from Reuters, and we've got Mark Bailey from Equasia joining us. And we're here to chat about the bond market or the equity market. Please feel free to give us a call on 1300 30 34 35, or you can email us, and the email is yourmoney@skynews.com.au. Before the break, we were talking about the various changes in interest rates and the like, but the one thing I want to talk about is the great rotation. The idea that the people were moving, everyone used to say it was from bonds. I actually think it's from the cash markets, from term deposits into equities. And I think the theme had been, let's buy the four majors and Telstra, because if I had a term deposit from Westpac, I might as well buy the equity. It's about the same. How do you read that, Mark? What's your interpretation of the great rotation?
I mean, I agree with you. I think it's out of cash into risk assets, whether that be bonds or into equities. And if investors are making that comparison between term deposits at 4.5% and banks, dividend yield at 7-8%, fully franked or whatever it is, that's a hugely dangerous comparison, because they're completely different assets, and the risk attached to those is completely different. And investors that are just looking purely at yield may have a successful 1-2 years, but eventually they will get unstuck, and they'll get burnt by following that type of methodology. Is that your thoughts on it, John? Because I saw CBA. It's now a $113 billion company at the $70 mark. It's now down to about 68 and change. It's not a massive movement, but a lot of volume takes place, and you've moved so high from. In December, it's around about $58.
Yes.
It moves to 70. Do I start buying now at 70? It creates a lot of volatility, and you say, well, it's a 5% dividend, that's probably all right.
That's the danger. And I think that if you're moving your money out of cash to go into an equity, and say you say, well, I like the idea that it pays the dividend, but you realize that you're buying an equity, and you do your homework, and you say, I like the banks, I think they're great, I think the mortgage market looks better, the property market looks better, that's what they're depending on, that's fantastic. But if you're actually buying CBA shares as a bond, returning you a yield as a safe place to put your money, and not looking at the other parts of it, then it's very, very dangerous.
And don't get me wrong, I think CBA, I think all the banks are really good at it. I mean, have no problems with it whatsoever. It's just a combination of, it's not a bond. And just accept that I'm now going to be an owner of the company as opposed to lending to the company, and it has different ramifications.
And there's a danger that the price will go too high because there are too many people buying it for the wrong reason, and that is a bit of a bubble. And it might get to a saturation point because everybody has done so well so far, and it's sort of like, geez, I better jump in here as well. And buying at these levels, unless you've done your homework and you're convinced that's the way to go, then it's.
And it opens you up to some of those trading strategies from the hedge funds, and that those black box type trading, and all of a sudden CBA is under pressure at 65, and you're in at 70, and you're saying to your broker, what do I do now?
Well, those guys did get burned, those hedge funds. But
hedge funds often get burnt. There might be a few burnt on FedEx. Now, what we want to do is we want to show you a chart of a US bellwether. It's FedEx. Now, clearly not all the viewers at home would be buying US equities, but it's interesting to show you what is seen as a snapshot of what can be a volatile market. FedEx is often seen as the driver, the economy within the economy. If the US economy is moving well, they've got to move their goods, and it really dominates the space. Now, it's not to take a view on FedEx itself, but it just shows some of that volatility, because Goldman's put out new reports on sustainability about what's the retail world going to look like, and as a consequence, we're all online. Well, have a look at that share. What do you think of that one? That creates some mayhem.
Well, I mean, I guess it just perfectly highlights, the volatility that you can expect in equities. Even fairly safe, stable companies like FedEx, which, as you say, should be doing particularly well in an online world where people are ordering clothes and books online and getting them shipped. Even if they come out with bad results or bad outlook, then you're going to get hit, and you could get hit 5-10%.
Right. A bit like the old Dow Transports, aren't they?
Exactly. I was talking to a US analyst, and sales guy on this week, and I asked him about the FedEx, and he said, "Look, it's out of left field. This is something that our clients, with that sort of movement up, that was a CBA to his portfolio. He would have always had a bit of FedEx because the economy is starting to bubble along. It's doing really well. Buy that." Now, I'm not saying that will happen to CBA and Westpac, but again, if it did, it would be quite. That's a bit tricky. That's not what I really want to see.
No, that's right.
I think the key comes down to the capital structure. You know, for the viewers at home, do you want to walk through the capital structure in terms of where it all ranks in the senior, the subordinate, how that plays out in terms of the return you should be trying to gauge?
Yeah, I mean, I guess it works in reverse. So if you're an equity holder, you're at the bottom of the capital structure. So in a bankruptcy or liquidation situation, then you're going to be the first one that has to, you know, kind of lose their investment. Then it's the subordinated bondholders are the next, and again, you want to your return from the equity holders should be slightly lower because you've got less risk, and then you're up to the senior bondholders, and then senior secured. As you go up that capital structure, whether it's either through structural or contractual seniority or subordination, you're getting paid less for your money because you're safer, and in the likelihood that you do lose money, those losses should be lower or maybe not at all. And that's how people should think about the capital structure. So if you're buying a CBA senior bond, you're right at the top of the pecking order behind, you know, depositors and the covered bonds that they've issued, and then it's subordinated, and then equity is right at the bottom. So, you know, if anything was to happen, then you would be the first to lose your investment.
Terrific. We're going to go to an email. It's Sheila from Balmain, and she writes, I'm concerned about interest rates, and are they going lower, and should I buy fixed or floating rate bonds? John, let's go to you with interest rates. What are your thoughts on interest rates? You made some outrageous claims there going over. In terms of for a person 2 3/4, if you're right, what do you think they should be doing about those different bonds, fixed or floating?
Well, again, you've got to be a bit conservative because obviously all forecasts, all my forecasts don't come out right. And so, I mean, these are very, very attractive rates right now. I do think they're going a little bit lower. But not massively so. I think we could get to 2.5%. So I would have a bit of a mix, to be honest with you. I think I would take the chance that we're going to see a lower cash rate, and so you'd want some of it floating, but certainly at these levels you'd want some of it fixed as well, because you know they're not going to go to 1%. We're not going to see what we saw in the U.S. or other places. So yeah, there is a natural bottom to it, but I would have a bit of a mix.
I really like the Rumsfeld approach. The Rumsfeld approach is you don't know what's going to happen. You don't know what you don't know. So,
That's right.
So I do not know where interest rates are going to go. Otherwise, you know, I would be in Barbados on
That's
my own
right. If you listen to the drum beats from the RBA, they're not going higher. Put it that way. So you don't have to rush out and lock everything in just yet. But you know, these are attractive levels to lock it in, and if they don't go down more, then they will start to float.
Yeah, over time. And we used to think that the US rate, we Australia would go closer to the US rate at 0, so we would lower rates straight away. Then the US starts to bubble along, and it came back that, oh, hang on, they might be coming to us, didn't they? The rates in the US, they were saying they might go up. But Bernanke came and said that's not going to happen, didn't he?
Yeah, he kind of reiterated his view. I mean, the FOMC meeting notes were pretty much exactly the same as the previous ones. There was hardly any change in any of the wording at all. So steady as she goes from the Fed. You know, they're happy until, you know, unemployment hits that 6.5% level or gets close to that, and inflation goes above 2.5%. We're going to, you know, keep with the QE.
Where's that unemployment in this stage now? What is it, about 7.5?
Yeah, it's
7.3, 7.4.
It's just dropping below 7.5%.
And when you hear, you know, Bernanke said get it down to 6.5, that's in sight. But what people don't seem to realise is the sequester, the whole, the turbulence in the US employment market is quite severe, I think.
Yeah.
I mean, is that your interpretation of how the US employment? It's soft here. What's it like over there?
I mean, you know, I guess
you were helping the economy along with you.
Exactly. I mean, I guess I've just come back from the US, so it seems to be definitely improving since the 18 months ago that I was there. The key difference is on the housing market. Without a doubt, you're seeing less for sale signs everywhere across. I mean, I was on the eastern seaboard, but wherever you went, there was less for sale signs. And I think that's shown through in the official data. You're seeing house price stability. You know, turnover is improving. Retail was still seemed to be under the pump. The shops that we frequented, you know, you got big sales on, and they were pretty quiet. You know, the restaurant businesses were still doing pretty well. But you know, I think property, both commercial as well, there was a lot less voids in retail space as well. You know, even some of the second-tier malls were starting to get tenants back in as well. So, I think the economic outlook that I could see in the States was a lot more positive than it was 18 months ago, and that definitely came through in the conversations I was having with Joe Public as well. It was certainly more positive, and they were a lot more positive about the future. One issue though that they did have was the tax side of things, both for their business and personal. That still hasn't been decided. That ties in obviously to the sequester and what happens there with the debt ceiling negotiations, and with that they need to get that sorted out before they will really feel comfortable and be able to plan forward.
Tax hikes are off the table, they tell us, but we will talk about that after the break. We have to go to another short break. Please give us a call on 1300 30 34 35 for any questions you have on investing, or you can email. The email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to Your Money, Your Call. On the panel tonight we have John Noonan from Thomson Reuters, we have Mark Bailey from Equasia. If you have any questions at all in the share or bond market, please pick up the phone and give us a call on 1300 30 34 35, or email. The email is yourmoney@skynews.com.au. Just before the break we were talking about the United States, and I wanted to get your thoughts, John. I'll start with you. The sequester, I think it's hard to understand what's actually happening. The market carried on, the economy looks good. Is it something to just ignore? It's not a big deal.
It's another slow burner, and Bernanke, he always mentions it. And I think it's one of the reasons that he gave for leaving things as they were. I think for one thing, he doesn't want to fix what's working, and he doesn't want to move too early to take that accommodation away. But also, he said the politicians, Washington, has to get its act together on that, because as you say, it doesn't hit right away, but that's not how the sequester works. It's going to be gradual over the year, and it's going to have like a cascading effect right through the whole economy. It's not just, as you mentioned, we were talking the other day, it's not just defense spending, but all those who supply the defense, all the private companies.
They outsource it all through
exactly,
the years.
Same as the U.S. car industry. So there's an enormous amount of the economy that will be felt. It's not being felt on Wall Street, so Wall Street's insensitive to it. And I don't want to sound that political.
They're
but
naturally insensitive.
They're naturally insensitive because it's not affecting them. Yeah. It's affecting Main Street rather than Wall Street.
And they think corporate America will respond by just sacking people and working out. But I've got a two-pronged question for both of you. One, I think, is that it might give stimulus to the Republican mantra that, look, nothing bad happened, cut more costs. More and more tax, so they'll be more strident in their negotiations. And then the other point is, we talk about Europe being really bad regulators, really bad policy makers, really bad decision makers. Here's Bernanke saying, you've got this completely wrong. Now, one of them are right. It's either the Republicans and to some extent the Democrats, or it's Bernanke, but they're not even saying we're close to agreeing on anything.
No.
Is that how you take it in terms of the stimulus the Republicans are going to get, and who becomes right in your mind?
Yeah, I mean, I guess he's a great student of the Great Depression. So what he's trying to avoid, and he's going to do everything within his powers to avoid going down that path again in terms of deflation and seeing an economy falling off the cliff. So he's going to press all the levers that he can do, flood the market with cheap money and try and stimulate the economy that way. But against that backdrop, you've got the two-pronged issues in terms of the debt ceiling. You've got to try and control your budget, and the US is in a fairly serious predicament. Obviously not quite as bad as some of the countries in Europe, but if it continues, it will get there. And one of the saving graces with the States is that it has the US dollar, which is the reserve currency of the world.
Let them get away with murder.
Exactly, and they can continue to print money if necessary.
And by that, for the viewers at home, what you mean is, if I borrow, I make everyone else borrow in my currency.
That's right.
Then I completely dominate the circumstance. Whereas Australian companies go to the US and they borrow in the US dollar, and if the currency goes against them, they've got to pay it back in US dollars. Whereas in the United States, God bless them, we are America. We'll borrow. You have to get dollars to lend to me.
That's right.
Yeah, I mean that's generally right. I mean, Aussie companies will generally hedge that exposure at the time of the issuance, but it's the fact that it is the global reserve currency, and it is the currency that every central bank will hold within their reserves. Right. So it's kind of almost irrelevant. Yeah, it's almost irrelevant where it goes to.
Well, John, you're a currency guy. That's how you started. What currency wars? Are we in one? And if we are, who are the combatants?
Yeah. Well, it's a bit of a cold war, and yes, sir. There's two types of currency war, playing the currency war. One is the countries like the United States and the UK, the Bank of England, where they have policies that really help their currency go down. So they're not overt. They're not in the market selling their currencies and buying another currency. They're simply coming up with policy that ensures that happens. Whereas
Can you give me an example of a policy that would ensure that that would happen?
Well, what the U.S. with quantitative easing.
So they go out and print money?
They print money, increase the supply of something, you're going to devalue the worth of it. And the same thing has happened in the UK. Bank Japan is the big one. So then the other style of currency, the currency war, is to actually just go intervene. You're seeing that in a lot of the Asian companies. Japan's done both in the last year. They're desperate to get their currency weak. So what Japan is doing right now, and their currency is weak, the Korean won, for instance, has appreciated 20% against the yen. They compete in the same markets. They're exporting to the same stuff
car
to the
businesses.
So it's really unique happening. So so South Korea is going to respond by intervening, and so that's the currency war. The amazing thing is, though, the one player who's not in the currency war at the moment, and the one that gets mentioned all the time, is China. China, even though they control their currency and they keep it very orderly, China's allowed their currency to appreciate a lot because China's realized that they can't be an export dominated fixed asset investment economy. They need to have a consumer economy, and they need to allow their currency to strengthen, one, to fight inflation, but also to give their consumers more spending power. So the yuan, I was looking at a chart the other day, yuan's one of the strongest currencies in the world over the last 2 years.
The Americans have stopped complaining about it.
Well, it's not an election year, but they would if it was.
When we had John Pierce here last week, he was talking about China and inflation, and he said all roads lead to China. It's either going to be the economy that drives us further forward, or it's the economy in which we sail our boat and hit the rocks. What's your interpretation on China?
Well, very interesting. I think that China's got a lot ahead of them, and the good thing is that the Chinese authorities are more bearish or more worried about their challenges than the China bulls out there in the market are. China does have a problem with inflation and mostly asset bubbles. It's the real estate sector. That shadow banking, just creating way too much liquidity. All the QE programs around the world, a lot of it ends up in China, flushed into their credit markets, unwanted credit. So, yeah, they've got it ahead of them. I think that what they will do is this year they will act to stem those bubbles in the property market, which means in the short term probably lower growth. They'll sacrifice some growth to get on top of their inflation and some of their asset bubbles.
Your thoughts on China?
I mean, I guess China for me is kind of, even if it grows at 6%, it's a high-class problem. I mean, how many countries in the world would wish that they could grow at 6%? And that's, even a very pessimistic growth forecast on China, it's going to be probably 7.5%, 8%. So I think, China will continue to tick along. I think the authorities have the fingers on the pulse. They have the economic levers that they can pull and manipulate to get there, and I think they're well adapted to do that. So I think China is one of my, I guess, least concerns for 2013. My key focus is still in Europe, and I think China will manage an orderly slowdown. I think we'll get a soft landing in China, and I think China's, one to watch, but I think kind of is kind of way down on my radar.
But what about the social fabric of China? I get what you're saying. 6% is a great return, and having had 9, and then you go down to 6. That's a big movement, and I don't always think that we should focus so much on GDP. I understand all that, but one party, it's a one-party policy, so it needs to have a happy people. And the reason around those asset prices going up is everyone's happy they're going up, but the policymaker isn't. That, I think it'll be a very hard conversation to talk to the local Chinese.
It is problematic.
Is down.
It is problematic, and it's one of the things that Nomura gave a great report on that, and they say Chinese authorities realize that they have to put a clamp on some of the inflation pressures and some of these bubbles. But if the social problems are too much, and they don't, they'll grow great in 2013. But they're asking for trouble, a financial crisis further down the road.
And they might take that hit. We have an email that's just come in from Mr. G.C. Cooper, and it says, "Hi, I would like to further diversify my investment portfolio by investing in bonds. I have an allocation of less than 50,000. I am thinking of achieving this by purchasing the Vanguard ETF. Could you please give me the pros and cons of investing in this type of fund? Also, am I correct in reading the fund is currently paying a quarterly 7% per annum dividend?" Vanguard ETF, have you got any thoughts on it?
I'm not familiar with that product per se.
Let's talk ETFs.
But yeah, but again, it's if you've got that kind of money to invest in a bond fund, it's a good way to get a diversified spread across the market. I think the Vanguard fund and the other ETF funds will try and mirror the UBS Composite Index, which is a broad range of government, semis and corporate bonds. So that 7% yield sounds roughly about right, is where I would expect it to come out, but it's a good way to have an investment that's relatively liquid and get that diversification without actually having to buy the individual names.
Any negatives on the Vanguard ETF as far as you're aware?
Not really familiar with it. ETS is another area that if you're going to go into as an investor, you have to do a lot of your homework. They're fantastic, but you have to have a bit of nous about how they work.
I mean, I think, Mr. Cooper, it's like all these things, you do need to read about it. And we're very keen, because when we talk about hybrids, we're always being disparaging. It's because there's so much to read. I mean, Vanguard's clearly a great brand, so it's a question of, is it the right product for you? It's great to see that you're diversifying, because that's the key to this whole story. Is the story is diversification.
Exactly.
It's the comfort. It's the play golf, bridge, and go for a walk, investing.
And still
with
get
Mr.
sleep at
Rumsfeld.
night. Exactly.
Yeah, go to sleep at night and enjoy yourself. RBA, is it going to do anything in terms of that currency? Is there any reason for the RBA? You think it's 103. Sorry, what range do you think the currency is in?
Yeah, I think it's going to be between 100 and 106 for a while, depending on what happens in the if towards the end of 2013 the U.S. economy is going well enough and the politicians get their act together enough where there's suddenly market has to price out super accommodation from the Fed, the Aussie could come down quite a bit. But I think for most of this year, it's going to stay in that 101 parity to 106 range. The RBA seems comfortable with relatively comfortable where the levels are now. More comfortable than they were, say, a few months ago, when you had like Heather Ridout and the others saying that
the RBA are very comfortable. Look, we'll call that a wrap. Thank you very much for watching the show. I thank John Noonan from Reuters, and I want to thank Mark Bailey from Equatia. Next week's Good Friday, so we won't be there, but after that, Steve Lambert and Roger Montgomery for the week after. Have a great weekend. All the best.